had an article nationally syndicated and published. The cure for high prices is high prices. Obviously, the market right now, very frothy in Sydney and Melbourne, a lot of press about it. What exactly does that mean? The cure for high prices is high prices. Can you explain that to us?
Yeah, it's funny. We had a really good reaction to that article, actually. The response that that people probably wasn't expecting is it was actually so easily understood, because it's in suggesting that, just if you think about the logic of the cure for high prices is high prices. Just put it down to a basic commodity. If you're trying to sell me a muffin, and you get away with charging me $4 a muffin, and I pay the muffin, that's fine, and then you charge me $4.50. It eventually gets to a level when you charge me $7 that, you know what, I don't like muffins that much anymore. And eventually it reaches a limit. Now it's either my disposable income, that I don't have enough to do it anymore, or where it's the fact that I just really, we're not going to meet the market at that price, depending on the importance of that product. So let's say a house. So now as we cross over into a house and those dwellings, eventually the price of property gets so high, okay, the market just can't afford it. There's an inevitability to it. Let me take you back to something that my professor taught me, and it's just that. There's an old saying that is an asset's value can't be outstripped by people's ability to afford the asset. Okay, and just play that out. You know, if you need to push rewind for your audience, an asset's value can't be outstripped by people's ability to afford the asset. Think of it like gravity. It can't be defied. What I'm saying to you is eventually prices get so high. Let's look at Sydney and Melbourne right now. Prices get so high that the repayments at the end of the day, call it, so it's not the ability of the bank to lend you $850,000, but your ability to pay back $3,000 a month, $4,000 a month, $5,000 a month as a percentage of your income is so much that the price stops, okay? Now, eventually that gets to a situation where all of a sudden the incentivization now, for me as a developer, let's call people, you know, I don't have to be a developer per se, but it could be just a couple owning a house and they decide, well, it makes sense now to cut a line down and I'm going to live on that side and I'm going to sell that place as a development. That's called the market clearing price. Eventually, prices get to a level where it encourages people to participate in that market and make more of it. Okay, back to your muffin scenario. Price is now $8, we need to make more. Eventually, you've got so many vendors on the street selling muffins, okay, obviously, and all of a sudden they're going, wow, there's too many muffins and not enough take-up, not enough supply. And all of a sudden the price eases back, and then there's a race to the bottom that goes the other way. You know, you don't need to just focus on property to understand that point. You could go to commodities right now, and eventually you send prices down to $50 on iron ore, and still people didn't want it. And still trending down to $40. So
It sounds like you're talking about price elasticity.
absolutely, absolutely price elasticity. And you know what? It's bang on. And for people to understand, to get their head around property investment, which otherwise up to now has been called a mug's game, it doesn't need to be. Okay, these are really simple notions that the common investor who only needs to purchase 2-3 properties over 10 years to make a couple of $1 million, for them to understand and get their head around, they can nail this thing from those little simple pointers there.